Hey everyone, this is Doc Investing and Trading 101. Today we're going to be talking about the option Greeks. I'm sure a lot of you have heard of the Greeks when referring to options, and what they are is the option Greeks measure the different factors that affect the price of an option contract. So we are on Robinhood here, looking at the call options for AT&T, and we're going to look at this first $35 call. This is the at-the-money call, and essentially we are going to be looking into all the Greeks, which are the delta, gamma, theta, vega, and rho. And each of these terms represents a different thing with the contract. It represents different, pretty much they all each represent something different. And we are going to get into that today. So before we get into that, we're going to discuss a little bit of what these Greeks can do for you when trading options, because understanding and knowing these Greeks is very important when trading options. It can help you determine a lot of things, such as you can gauge the likelihood of an option if it will expire in the money, or essentially your probability of profit. And you can do that by using the delta. We'll talk about that more later. Then you can estimate how much the delta will change when the stock price changes. So this delta is always moving, and you do that using the gamma. These two, gamma and delta, really kind of intertwine. You can determine how much your option will lose in price each day using the theta. And using the rho, you can simulate the effects of interest rate changes. So the rho pretty much represents if interest rates go up or down, how much the contract price will move. And Vega is more or less the volatility. It's how sensitive an option might be to large swings in the underlying stock. So that is essentially a quick overview of what each of them are, and now we're going to get further into them and dig a little bit deeper. So first, we are going to get into delta. The first Greek, which measures how an option's price is expected to change per $1 change in the price of the underlying security or index. So essentially what that means is for each dollar AT&T moves, this contract price will go up $50 for the first dollar. So if AT&T went up $1, this contract would be worth about $83. It would go up $50, or 50 cents times 100. So that is one thing that the delta is used for, and that's mainly what it's used for, is to tell you how much the options contract, the price of it, will move for each $1 move in the underlying stock. Options that from calls have a positive delta, so call options have a positive delta, put options have a negative delta, and so using calls, the range for the delta is between 0 and 1. It can't go higher than 1, and it can't go less than 0 on calls. And for puts, it's pretty much the opposite. It's from 0 to negative 1. At-the-money options usually have a delta near 50 cents. So looking at this example here, this is the at-the-money option, and it's got about a 50-cent delta. And we could look at pretty much any security, and it would be about the same. So this is for next week, 51 delta, about, pretty close to 50. So that's one thing to note. The option delta will increase as the option gets deeper into the money. So we're going to be looking at calls here, and each one of these calls is getting deeper in the money, and the delta will be going up on each one of them. So this is the first in the money delta, 71. The next more in the money should be higher than the 71, and so on. So this one's 92, this one should be in between those, and so on. And the more in the money, the closer to $1, because for each dollar that the security would move, the delta would move $1 because these contracts are in the money. And likewise, the delta of out of the money call options will get closer to 0 as expiration approaches. So when you're looking at these kind of far out of the money contracts, the delta will be going down as they reach expiration. So as you see, we have out of money option. The delta is about 5, and then it goes down to about 3. So it really, $1 move won't affect the option price so much because it's so far out of the money that, and it's getting closer to expiration. So, it's just not much of a big move as an in the money option. And so for put options, it's pretty much the exact opposite. As I mentioned, they have a negative delta from about 0 to -1. The delta of at the money options is usually about 50 as well, but it would be negative 50. So that's one thing to note. And it's the exact opposite. So the delta of an out of the money put options will get closer to zero as expiration approaches. So pretty much again, once it's out of the money, it will become worth less and less as the expiration date approaches. And two other ways that you could use the delta is one of them is to measure the probability of profit. So when looking at one of these call options, you could look at this and say it's got like a 10 or 11% probability of profit. And the higher in the money, you could say this one has about a 95 or a 96% probability of profit. So this one has a much higher probability, of course, because it's already in the money. Next, we're going to talk about gamma, which is the rate of change in delta. So one thing to note is that this delta is only for the first $1 move of the price. So if we bought this contract right now for $33 and AT&T went up $1, this delta would go up 50, but if it went up another dollar, it would only go up 48. So essentially gamma is how much the contract will go up for every dollar outside of the first dollar. So it goes up, you use the delta, it goes up $1, it goes up $2, you're going to be using the gamma price. So to break it down, if it went up $1 right now, we bought it for 33, we have a delta of 50, it goes up $1, this contract will be worth $83. And then we go up one more dollar in price, we would do the 83 plus that 47. We reopen that. So we would do the 83 plus that 47, and that is how we would use the gamma. And for every dollar after that, we would continue to use the gamma. So why you would use this is exactly for what I just mentioned. And essentially, the delta is kind of always changing, and the gamma is more reliable for each dollar after it goes up, and the delta cannot exceed 1. Gamma decreases as an option gets further in the money and delta approaches 1. So to make this easy, we're going to do a deep in the money contract. Looking at this one, we have a high delta at 81, and we have a low gamma because together these cannot go more than 1. 1 is the maximum. So this you would never see an 81 delta and like a 20 gamma because that would be over 1. The gamma goes lower as the contract becomes more in the money. And likewise, next thing we're going to talk about is theta, which is time decay. Theta is really important. Essentially what theta does is it measures the change in the price of an option for 1 day decrease in its time to expiration. So pretty much the easy way to put it is that if you buy, we'll look at it in the money contract. So if you buy this in the money contract call at $66 and pretty much the next day it will become minus $2. So every day it's losing about $2.50 almost. And that's exactly what the theta is used for. So every day the contract will lose value equal to your theta, and the theta will be less and less for in the money contracts and more for out of the money contracts. So one thing to note is that because time erosion is not linear, theta of the at the money options and the just slightly out of the money options generally increase as the expiration approaches. So the further out an option is out of the money, as it gets closer to expiration each day, the theta will go up because essentially it's going to be expiring worthless unless it makes a big move. And so when looking at theta, at the money options have the least theta, so they are they're all pretty much headed to zero, but then we have in the money options and out of the money options, which lose value the quickest. Next we have Vega, which is the sensitivity to volatility. So when looking at Vega, what it does is measure the rate of change in an option's price per 1% change in the implied volatility of the underlying stock. So one thing I mentioned in my last video was implied volatility and how it affects options prices. And here we have our implied volatility percent. And essentially, as implied volatility goes up, contract prices go up. So if this had a 50% implied volatility and all of these Greeks were the same, this contract would become worth more in value. And that goes the same for puts. So puts and calls both uh, gain in value as implied volatility goes up, and as it goes down, contract prices also go down. So Vega measures how the implied volatility of a stock affects the price of the option. Volatility is one of the most important factors affecting the value of options. So in my last video, we talked about straddles and strangles, which are heavily reliant on volatility. And Vega is essentially volatility, and it's kind of easy to remember V for Vega or volatility. So that's how I remember. And a drop in Vega will typically cause both calls and puts to lose value because that's more or less a drop in implied volatility. And likewise, an increase in Vega will typically cause both calls and puts to gain value. So pretty much Vega volatility. So far, to recap, we have delta, which is the amount the contract will move for the first dollar that the underlying security moves. Then we have gamma, which is how much the contract will move each dollar after the first dollar. We have theta, which is time decay. Vega is volatility. And our last Greek for the day is rho. And essentially what this follows is it follows the interest rates and how an interest rate cut or a hike could affect this particular contract, and that varies between securities. Some sectors and stocks have bigger changes the more the interest rates get cut, such as banks. Those are a big one. But when looking at AT&T, it's not too much. And so as interest rates increase, the value of call options will generally increase as well. And as interest rates increase, the value of put options will usually decrease. For these reasons, calls options have a positive rho and put options have a negative rho. So here we're looking at a put option. And so if the interest rates increased, these puts would become worth less in value, and likewise the calls would become worth more in value. Rho is generally not a huge factor in the price of an option, but it still is something that should be considered, and it's still part of the way that the options price is calculated. So pretty much that's the basics for the Greeks. I don't want to get too deep into it or overcomplicate things because essentially that's how options are priced using these Greeks. And I hope you guys learned something today. This is something that once I kind of figured out and studied a little bit more, it really helped me when looking at options because there's just so many things that you can look at to determine if the option is really worth your while or too risky. And so that's one thing really to note. So I hope you liked the video today. Please subscribe to the channel, check out my other videos, and we'll talk to you guys soon.